look at the cost of capital for a project in Germany, which is AAA plus, it's about 8%. That same project in Argentina, which is a sovereign rating of triple C plus, is basically 60%. So the gap is really wide in terms of the cost of capital.
How do you account for the fact that you still owe these dollars, and the local currency that you're generating is not sufficient to handle it?
We live in such an interconnected world, and we need tools to make our financing system fairer. And we hope that this will, bringing the world of development and finance together, will allow us to create a more equitable world.
Welcome back to Afri-CAN. At Pharo, we don't like boundaries. We're all about taking worlds that are separate, some would say opposed, like profit and non-profit, corporate and developmental, and bringing them together on the basis of our shared humanity. Within Pharo Foundation, we combine non-profit Pharo development projects with for-profit Pharo Ventures social enterprises in the pursuit of social impact. And beyond the confines of the foundation, the Pharo ecosystem is driven by Pharo Management, a unique emerging market hedge fund where every employee stands proud of the social impact in East Africa of their sister organization, Pharo Foundation. Today, we are going to demonstrate the power of profit with purpose through a very special episode which bridges the interests of the fund and the foundation. I have invited Roopal Kanabar, CEO of Sustainabar, and the Chief Risk Officer at Pharo Management, Christopher Hunter. When I met Roopal, she summarized her genius idea in a nutshell. She said, "What if we could harness the power of remittances to developing countries and use them to create foreign exchange hedges for development finance investments in the developing world? On the one hand, we know that currency losses are one of the major disincentives against foreign local currency investments in Africa, and a viable FX hedging mechanism would increase its volume. Meanwhile, remittances, which are funds transferred to home countries by individuals living offshore, constitute a substantial component of global financial flows. In many countries, remittances surpass foreign direct investment and official development assistance, accounting for up to 50% of GDP. So why not aggregate large volumes of small remittances made by the diaspora through remittance platforms and develop a liquidity pool used for FX hedges for development investments? This is something that has never been done before. So I have invited Roopal to explain her project and Chris to discuss its relevance to finance as well as its viability. In 2019, Roopal embarked on a journey to combine her knowledge of finance with her passion for development and sustainability. This led to her founding Sustainabar, a finance advisory firm providing socially and environmentally sustainable investment solutions. Prior to this, she held several senior finance roles within corporate credit risk, loan trading, corporate derivative sales, and structuring at Citibank over a decade. She brings thought processes and instruments used in traditional institutional finance to the sustainable investment space. She has a portfolio of clients and carries out strategic advisory work for a number of organizations in various sectors, including UN agencies, not-for-profits, asset managers, and impact investors. Our second guest, Christopher Hunter, is the Chief Risk Officer at Pharo Management. He has more than 25 years of experience working across hedge funds and banks in various structured product trading and quantitative research roles. Beyond the experience he has accumulated on Wall Street and the city, Chris has a thorough academic understanding of financial math, having lectured in the MSc in Financial Math at Oxford University, as well as King's College London and the Courant Institute of Mathematical Sciences at New York University. Before moving to finance, Chris completed a PhD in theoretical physics on the nuts and bolts of entropy under the supervision of Professor Stephen Hawking. So let me tell you, this is going to be a good episode. So my first question is, of course, to Roopal, so that we can better understand your project. So could you please explain in simple terms, if that's possible, why you're targeting remittances as a hedging mechanism? And could you also explain how the aggregate liquidity pooling of remittances works and how it reduces the costs of remittances for the diaspora at the same time as it reduces the foreign exchange hedging costs? Good luck.
Thanks, Francesca. So as a starting point, I think it's really important to define what remittances is or are. Remittances are monies such as $200, $300, they're sent by the diaspora community back home to their mum and dad, right? So these are funds transferred by individuals to their countries of origin and particularly benefiting the global south. These actually constitute a substantial amount of global flows. In many countries, as you mentioned, basically remittances surpass foreign direct investment, FDI, and official development assistance. Often they account for up to 50% of GDP of a country, which is a huge amount. So remittances are really a vital link between the diaspora and their origin countries, serving as a means of economic support as well as to uphold family, cultural, and social responsibilities. In 2024, the formal global remittance market was valued at $950 billion. That doesn't include the informal channels like you're buying a laptop for your brother or just sending, I don't know, a TV back home. So that's just the formal measured market. And the flows are expected to continue upwards. And it's anticipated that by 2032, this will be over $1 trillion. That's a huge amount of flows. At the moment, they're all disparate and just going through various channels back home to mum and dad. So that's the remittance side. The second side of the solution is, why are FX hedges needed? And Francesca, you did touch on that at the outset. Local currency investments in the global south are really a cornerstone of effective climate finance. If you have an entrepreneur that's got an investment in dollars and suddenly the local currency devalues, though the quality of the operator has not changed, it's still really good, the work that they are still doing is really good, they suddenly default because they can't afford their $1 million repayment. So to reduce risks, enhance project sustainability, and empower local communities and economies, we really do need to start looking at providing investments in local currency. Until we do that, we won't build out local resilient economies, and capital won't move at the scale that it needs to, right? So there we've defined remittances, we've defined FX hedges, and I think there's many tools that are needed in the toolkit when it comes to FX hedging. This issue has been around longer than I've been alive, right? And so until we solve for it, it's just we can do many, many other things, but capital won't move at scale. So what is the solution that we're proposing here? Actually, I'm going to take a step back. So I worked, as you mentioned at the outset, I worked in the derivatives space at Citi for a long period of time. And basically, I was reading a paper when I was presenting at a diaspora conference last year, and it said $100 billion is remitted to Africa every single year by the diaspora. And even during COVID, this amount held steady. So if we look at, my derivatives brain started going, well, if we actually look at the cash flows associated with the remittances, it's sell foreign currency, so sell your euros, sell your dollars, sell your pounds, and buy the local currency, whether it's Malawian kwacha or Gambian dalasi. These are opposite to those required at investment maturity for a foreign currency investment, which is sell Malawi kwacha, sell the Gambian dalasi, sell the Kenyan shilling, and buy the dollars or pounds or euros. But there's a huge timing mismatch, and obviously the sizes are very different. So we have lots of $200 tickets coming in from the diaspora, but what we really need for the foreign currency investments is $1 million. So what we've done is we have basically structured a solution
which includes very simple working capital facility and an escrow account to allow us to form a liquidity pool using these remittances to create cost-effective FX hedges. Now, Chris and I met yesterday, and there's a number of very difficult parts to this that we need to work through in terms of the modeling and bringing people together. But essentially, the two flows are opposite. And by doing this, by pooling remittances, governments and or financial institutions can access foreign currency for innovative FX hedging, which will stabilize local currency, addressing the key currency risks, right? The net cash flows for all the parties involved, including at the sovereign level, don't change. Rather, what we're doing here is that the solution allows existing private sector flows of capital to be used more effectively to reduce silos and create a public good. I won't go into all the technicality here, but that is available for anyone who's interested, and I'll pause there. Hopefully that gives you a bit of a background as to what we're seeking to do.
Brilliant introduction, Roopal. I don't know how you managed, but it actually was put in simple terms. Thank you. So as a follow-up to this intro, I guess you say that by pooling these remittances, governments or financial institutions can access the bulk foreign currency to provide the FX hedging mechanisms at lower costs. But what I'd like to know is, what is the role of multilateral development banks and development finance institutions in scaling a solution like this? And also, how they're responding to your idea so far.
Yeah. Sorry, Francesca, the other thing that I didn't touch on is, yes, the FX hedging, but also remittance costs to Africa at the moment are 8%. So every $100 that you send, 8% goes to various middlemen or entities along the way. And so what we're trying to do is actually to reduce those costs so mum and dad on the ground receive a larger part of funds. So that's really important just as part of the introduction. Now, when you talk about multilateral development banks and development finance institutions, I think perhaps it's worth just defining what these are for the audience, because many people won't be familiar with these terms. So multilateral development banks are international financial institutions chartered by two or more countries to foster economic development in lower and middle income countries. So that could be the World Bank, Asian Development Bank, European Bank for Reconstruction and Development, which we know as EBRD. Right? So that's an example of NDBs. DFIs, they're a broader category of public financial institutions, and they're really focused on economic growth in developing countries and supporting private sector finance to move to these countries, right? So DFIs and MDBs they have this key function of mobilizing private capital, and they are crucial in attracting private sector capital to these economies in the global south. So they are catalysts, and they often invest alongside private sector investments and provide the support. So this mobilization is essential to really meeting the UN SDGs as well. And so when we presented the solution to 15 MDBs DFIs in January of this year through the Fix Innovation platform, which is Finance in Common, and the audience noted it was the most innovative yet implementable idea they had seen in a long time when it comes to FX risk. So that was a very proud moment for us. Now, if I take an example of the renewables energy sector, 20 years ago, no private sector investors were really investing in the space. It was predominantly done, but investment was by MDBs, DFIs. Today, it's predominantly private sector investment. So similarly, by providing working capital facilities, guarantees, and those types of mechanisms to allow private sector's investors to actually participate in the space, I think that we can really move the solution along. And at the moment, we are getting good traction from them.
Very, very encouraging to hear that. Okay, I guess we can move on to my question to Chris. I guess I'm going to group my questions to Chris. Let's start with this one. So from the point of view of a finance specialist who's focused on financial risks, do you think that Roopal's project would have major repercussions on finance itself if it worked?
What we want to do is increase the overall capital markets that we have within some of these countries. I call them more frontier countries, where there is more difficulty in investors being able to make investments, and that's primarily because they have a large number of unhedgeable financial risks, I would say. And so Rupal talked about the FX risks and how those can be mitigated. And I'd start off by talking about how we could think about those FX risks in particular. There's what we call liquidity risk, and that's the ability to actually transact FX trades if at a reasonable price. So it's that if there's no one that has the other side of the trade or is willing to trade with you, then you just won't be able to transact your $1 million in order to be able to get the money out of the country. And so that's something where the pool of diaspora remittances provides that liquidity. It provides that constant flow that should allow these investors to be able to access liquidity. So that's the key thing is the liquidity risk is mitigated by having these flows. Another problem we have in the frontier countries is often the convertibility risk. Now, what is convertibility risk? It's the inability to actually transfer money out of a local currency. So there can be capital restrictions put in place by the country which prevent you from moving your money out. So it's different from liquidity risk, where it's just difficult to find someone to trade with you. You're just not allowed to move money out of the country. And so Rupal's idea there is to maintain offshore dollars. So before the diaspora flows, the dollars don't go into the country. They're held offshore. So that means that it's easier to, using the working capital in a very clever way. She's designed it so that the convertibility risk is eliminated because the dollars will be available to be transferred out. And then there's the actual market risk, which she touched on, which is, how if there's a devaluation of a currency, how do you account for the fact that you still owe these dollars, and the local currency that you're generating is not sufficient to handle it. And that's sort of the trickiest part of the problem, because you would find that often in these countries, there is a general devaluation of the currency. Now, in order to compensate you for this devaluation, in general, their interest rates in the local countries tend to be relatively high. So if you're able to access that, then the interest that you earn on your working capital will compensate you for the devaluation in the currency. But the question is, can you access the instruments that will pay you this higher interest rate? So that's one way to make the structure work. And the other way we're looking at is a gradual hedging of the overall position as the valuation occurs, in order to make sure that a large devaluation doesn't occur unexpectedly, and then that would cause you to lose a lot of money.
Very, very good sort of bird's eye view. Rupal, would you like to add anything to that on the sort of finance side of things?
Yeah, sure. So I think it's really important, like Krista's laid out the different risks that we're trying to address, which is great. It's really important to note that mum and dad, who the remittances are being sent to, are not affected at all. Right? So we're just using the existing flows and consolidating them and reducing silos. The net cash flows, whether it's for mum and dad or for the remitter or at the net sovereign level, don't change, which is what the beauty is of this solution, is that
that we're just using existing cash flows. Also, we're not creating a huge new entity. What we're doing through Chris's help is really looking at how we can weave this into the existing system. And there's different models for it as well, but the premise remains the same in terms of the convertibility, the transferability, and the liquidity, which is what we are doing here. And those are the three key risks for any currency trade.
Excellent. So back to you, Chris. What would you say are the main technical challenges in implementing Rupal's idea? And what kind of quantitative model would you have to build to find how much remittance flow is required for $1 hedge of FX?
I think that, with all these countries, it is going to be very specific to the actual country. It's difficult to know in advance exactly how you're going to be able to structure it. It's important that you have a good working relationship with the central bank so that you understand, they do have an influence on how the FX works, how you're able to access higher interest rates on deposit. So I think, a large part is understanding what the local scene is and being able to navigate that well. So that's up to Rupal. In terms of and then once you understand that, that's when you can begin to look at the modeling and, trying to understand exactly how the cash flows are going to occur. Can you hedge any of the interest rates risk? Do you need to transfer, start hedging early before the end date? I think, a simple case we would look at would be to look at, what are potential models for the evolution of the FX rate. And so that's something that at the hedge fund we do on an everyday basis. What do we expect the devaluation to be? What are the potential gap risks? And then model out what are the potential losses for whoever is running this FX risk. Because at the moment, we can move the risk around to different people, but at some point someone needs to bear the FX risk. And so understanding what the potential downsides are for say the guarantor of a FX transaction that we've agreed with the investor, means you can go to them and explain to them what are the actual risks that you're going to bear, what is the potential downside, what is the probability of that happening, and what is the potential upside. And so, I'm looking forward to investigating that more closely with Rupal as we dig into specific countries and get a better understanding of exactly what the playing field looks like.
Excellent. So to kind of conclude the discussion and to bring it back to a sort of more basic level, really, I'd like to hear from each one of you. How important you think it is to bring together the worlds of development and finance through this project. Maybe starting with Rupal?
Yeah, sure. So I think it's really important. Chris said, with the risk that is associated with this, we need to work out where it sits and which player it sits with. Right now, the FX risk sits with the least resilient entity in the chain, i.e. the SME or the project on the ground. So what we're trying to do is we're trying to move that risk from the SME level to the market, where this stuff is traded all the time, right? If we look at the cost of capital for a project in Germany, which is AAA+, it's about 8%. That same project in Argentina, which is a sovereign rating of CCC+, is basically 60%. So the gap is really wide in terms of the cost of capital. So bringing these two worlds together, we create more equitable and fairer form of financing, which affects everything from food security to migration to climate change. We live in such an interconnected world, and we need tools to make our financing system fairer. And we hope that this will, bringing the world of development and finance together, will allow us to create a more equitable world.
Very much a Pharo goal as well, I would say. Chris?
Yeah, I think that, that finance does have a big role that it can play in terms of helping to develop the infrastructure of these programs. I think, it's the expertise is clearly not on the ground, but it's in terms of how the money moves around, how it's hedged, and basically how the risks can be controlled. And I think that then gives investors and guarantors a much higher degree of confidence and allows them to move forward with projects that that they might not move forward with if they didn't have this guardrails in place.
Absolutely. I think that's a very, very powerful way of concluding this episode. So thank you so much to both of you. I wish you all the best, Roopal, with the idea and pushing it forward. But I think it would be amazing if it works out.